Should the government be involved in regulating executive compensation?
If the government is guaranteeing deposits or an institution is too big to fail and the government will have to bail it out, you have to expect some government oversight. If you're outside of that orb, I think the government doesn't belong in the business, and past efforts to regulate compensation have not been successful. And they may have actually contributed to some of the practices here that are risky. The overuse of options in the 1990s, for example, encouraged by federal statute.
Is it realistic to think that Wall Street would regulate its own compensation?
There is motivation to do that. I think the boards of directors of these institutions work very hard to design practices and business plans that support that. We'll see over time whether some of these really large bonus packages will be dampened.
What role did boards play in kind of creating an environment where financial services pay could be so closely tied to risk?
Well, I think boards are ultimately responsible here because they represent the owners. But the owners themselves may have encouraged the short-term focus and the risk because if you look at the average holding of stock from the 1960s, the average holding period was about 8 years. I think some of the studies now show it's less than a year. And a dilemma that boards have is how do you manage for long-term when you don't really have that many long-term shareholders? The dynamics have been that the sales-driven, the product-driven, the bottom line, quarter-to-quarter driven performance has encouraged aggressive risk-taking. And now the question is how will that be pulled back either through the government or in areas where there's no government guarantee, perhaps by the shareholders and the boards themselves.